Welcome to this explainer. Today, we're popping the hood on something that literally touches almost every single aspect of our lives and the global economy, yet somehow operates completely in the background. We are going to dive into how global regulators categorize the hidden mechanics of our financial system, specifically the insurance industry. And we're going to look at this whole thing through the lens of the Sustainable Industry Classification System, or SICS.
But before we really get into the weeds here, we have to establish who the rule makers are. Right now, that's the SASB standards, which are actually under the stewardship of the International Sustainability Standards Board, or the ISSB. You really need to know these organizations because they set the ultimate baseline for tracking sustainability and risk for investors and businesses all over the world. They're the ones deciding exactly how industries get defined and, crucially, what risks they actually need to report.
And this brings up a really fascinating question. How on earth do global regulators keep track of an industry that is fundamentally designed to price the unpredictable? Think about it. The insurance industry isn't selling a physical, tangible product. It's essentially acting as the giant shock absorber of a well-functioning economy. When natural disasters, accidents, or illnesses strike, these guys step in to soften the blow. But effectively governing that process, that requires a seriously specific framework.
So here is our roadmap for today's explainer. We'll start with the SICS financial sector, decode industry code F&N, look at traditional insurance lines, explore non-traditional insurance products, and finally, tackle systemic and sustainability risks.
All right, let's jump right into Section 1, the SICS financial sector.
What's really cool here is how these three acronyms actually work together to organize the entire global economy. The ISSB and SASB use the SICS framework to create 77 specific, standardized industry classifications. So instead of just lumping all businesses together in one giant pile, SICS carefully groups entities based on their shared sustainability-related risks and opportunities. And for today, we're zooming in on one very specific slice of the financial sector.
Moving right along to Section 2, decoding industry code FNN.
So the most important takeaway here is that FNIN is basically the official address within the SICS framework for the insurance industry. According to the standard, entities in this specific category provide products that enable the transfer, pooling, and sharing of risk. It doesn't matter if they operate in a single country or globally across a bunch of different jurisdictions. If a company is fundamentally in the business of managing risk, FNIN is exactly where they get classified.
Which brings us to Part 3, traditional insurance lines.
To truly wrap our heads around F&I, we have to split the industry into two distinct buckets. Let's start with the one you're probably the most familiar with, traditional insurance. These traditional policy lines do a brilliant job of illustrating the core mechanical purpose of the whole industry. We're talking about things like property, life, casualty, and reinsurance, literally the products that pay out claims when a house catches fire, an accident happens, or a natural disaster strikes. Their number one job is alleviating unexpected economic shocks for individuals and businesses.
So how do these traditional companies actually make their money? Well, it is a massive, high-stakes balancing act. They drive growth by collecting premiums, generating underwriting revenue, and crucially, they earn investment income by investing all those collected premiums. But there's a huge catch. The massive, looming source of uncertainty for their profits is future claim payments. They absolutely have to make sure they preserve enough of those accumulated premium revenues to cover huge, unexpected payouts down the road.
Okay, let's pivot to Section 4, non-traditional insurance products. Because the story absolutely doesn't end with your standard property and casualty policies. Under that FNIN classification, these entities are also heavily engaging in non-traditional products. We're talking about highly complex financial instruments, things like annuities, alternative risk transfers, and financial guarantees. Unlike your standard health or car insurance, these products operate entirely in the capital markets. They act way more like sophisticated investment vehicles. So they aren't just absorbing everyday physical shocks, they're intricately tied to the broader financial markets.
And when you look at this head-to-head comparison, the divide is super clear. On one side, you're protecting against a physical event, right? Like a hurricane or a house fire. But on the flip side, through products like credit default swaps or debt securities insurance, you're protecting against complex financial events, like a massive corporation suddenly defaulting on its debt. The entire nature of the risk literally shifts from the physical world over to the financial system.
Let's wrap things up with Section 5, systemic and sustainability risks.
Here is exactly why regulators care so much about this. If you misclassify a complex credit default swap as just a simple traditional policy, you completely miss how incredibly fast it can send shockwaves through the entire financial system. The SASB standards highlight this exact escalation pathway. When an FNFN entity heavily engages in these non-traditional activities, they instantly become highly vulnerable to sudden financial market movements. And if they fail, they don't just fail quietly alone. Their interconnectedness amplifies broad systemic risk, which could literally threaten the entire economy.
Because of those severe, non-traditional vulnerabilities, regulators can actually slap an insurance entity with a very intense label, a systemically important financial institution, or SIFE. When a company gets designated as a SIFI, central banks bring down the hammer. We are talking strict oversight, tighter limits on risk-based capital, incredibly strict leverage rules, and absolutely massive penalties if they step out of line.
So, to prove they aren't just a ticking time bomb, these FNIN entities have to rigorously disclose some very specific metrics about their non-insurance activities. They've got to transparently report their exposure to highly complex trades, like non-centrally cleared derivatives. They have to monitor the fair value of their collateral. They even have to maintain what are called living wills for a rapid, orderly dissolution just in case they face severe financial distress. Regulators demand to see exactly how all these liquidity risks are being managed.
Now, on the flip side of all that systemic risk is another really fascinating concept, sustainability risk. And it stems from what economists call moral hazard. The SASB standards specifically call out this phenomenon, where simply having an insurance product can actually reduce a person's incentive to improve their behavior. Think about it. If you know you're 100% fully covered, you might naturally drive just a little bit faster or take more physical risks, which inadvertently contributes to negative societal impacts.
But here is the really cool part. FNN entities have the incredible power to completely reverse this hazard. Because they're the ones pricing the risk, they can generate massive positive environmental and social impacts simply by financially rewarding responsible behavior. They do this all the time by offering premium discounts for using sustainable building materials, driving low-emission vehicles, having a great driving record, or even just adopting healthy habits like routine exercise. They're essentially using their product pricing to build a much safer, far more sustainable world.
So I'll leave you with this to chew on. We've seen how the SICS framework meticulously categorizes the insurance industry, from everyday property claims all the way to incredibly complex derivative exposures. But as climate change introduces wild new physical risks and financial markets invent even more non-traditional products, we really have to ask, is our economic shock absorber adaptable enough for tomorrow? Thanks so much for joining me for this explainer, and remember to always keep questioning the systems that run our world.